Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executive. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. I got this question: why taxes are not calculated on profit before tax as shown in P&L? Okay, let's take the case of a business entity. Let's say this is ABC Private Limited. ABC Private Limited has reported its sales, then it has deducted all its expenses, and it arrived at profit before tax. And on this, taxes are calculated, then comes profit after tax. Okay, so this is the normal process. And in banks, what they do when they evaluate the loan proposal, they look at what is the past financial performance. So they may be looking at past 3 years financials. They look at whether that business has made profits, whether tax is provided, whether tax is paid, all those. Okay. And then they will also estimate and do projections. There will be estimates, that's for the current year. There will be projections, that's for the future year. And they will calculate profits for the future, and they'll also calculate taxes on it. And most of the time what they do is they will prepare estimated P&L like this through CMA statement, and in that they'll arrive at sales, expenses, PBT, and when it comes to taxes, they'll generally apply the tax rate on the profit figure which they have arrived at here. So this is the profit. On this profit, tax rate, let whatever be the tax rate, they'll apply that, and then they will arrive at this profit after tax. If you ask me whether that is the right approach, answer is no, because your taxes, especially the taxes for business entities, are not merely based on profit before tax. Of course, profit before tax is the starting point, but it will undergo some changes because this profit before tax is something which is calculated following the provisions of Companies Act. Let's say in case of companies. So if it is a company, they have to follow the procedures prescribed in Companies Act. They have to provide for expenses. They have to provide for various items as per relevant accounting standards, Ind AS, and then they arrive at profit before tax. In that, there can be several items, there can be several expenses which would have been accounted even though it is not paid. Right? There will be several items accounted as expense, basically to follow the provisions of Companies Act, to follow the provisions of accounting standard. So when you incorporate many items and expenses, what will happen to expenses? That will increase. And when expenses increases, what will happen to the profit before tax? That will decrease. And that's not something acceptable for income tax department because they need more revenue. So in the name of fair value or in the name of fair disclosure, if you keep on be booking on expenses which are not being paid but they are just accounted, you are of course bringing out the real position to the readers of financial statement. You are communicating that this is the profit this business is making, but taxman will not be happy with that because you are reducing the profits, and consequently you are reducing the taxes also. So there is a fiscal provision for taxes. Taxman will say that let whatever be the way you have arrived at profit, let it be there. Let us recalculate the profit from income tax point of view. As a taxman, as an authority on tax, I will say what are the expenses you can claim as expense and what are the items you cannot claim as expense. So this gives rise to very important understanding. That is, whatever the expenses you book under Companies Act, it may or it may not be allowed as expense under Income Tax Act. For that matter, even depreciation. The depreciation what you provide here can be different from what is provided under Income Tax Act. And as a result, corresponding changes have to be made in the way the profit is calculated. Let's say, for example, my sales is 100. My expenses are 50, and following the provisions of Companies Act, I have booked a depreciation of 30. So 100 minus 50 minus 30, my profit before tax is 20. But for the same period, with the same information, if I am calculating my profit as per income tax law provisions, the possibilities can be, say, something like this. They will treat entire 100 as sales. Expenses, assuming that whatever expenses I have claimed is also supported by income tax. Okay. But when it comes to depreciation, for some legal reasons, they are not ready to consider entire 30 as depreciation. They are going to consider only 15 as depreciation. So what is happening here? The profit as per income tax is more, because 100 minus 65, the profit is now 35. And it is on this profit tax will be calculated. It is on which profit? This profit. So business entities, they will be making a computation of taxable income. They will be doing something known as computation of taxable income, which basically starts with profit before tax as per books. In our case, it is this 20. Then they will add back the depreciation, which is provided as per Companies Act. In our case, it is this 30. So 20 plus 30 is 50. Then they will subtract the depreciation which are permissible as per Income Tax Act. That is this 15. So 50 minus 15, what you get is 35. This becomes taxable income. And it is on this taxable income, let's say the tax is calculated at the rate of 30%. So that would work out to 10.5. So look how it is different. The profit before tax is 20. So on this 20, if you are going to calculate the tax at the rate of 30%, you will work out tax as 6 and you will have profit after tax as 14. But actually the tax is how much? 10.5. It is 4 higher than this. If figures are in crores, then it means you are doing a grave mistake by not recognizing this. Okay. So please have this realization. Taxes are not calculated on book profits. So when you do the loan analysis, when you do the estimation projection, do not blindly apply tax rate on PBT. Rather, you have to do this basic computation at least. And here I just added depreciation as per Companies Act and deducted depreciation as per Income Tax Act. But in reality, there will be various items which will be added back. Here depreciation is added on one side and deducted on the other side. It means to a certain extent it is taken care. But in reality, there can be many items which are not even allowed as an expense under income tax computation. it means you just have to add them back and you cannot deduct it. It means you don't have relief over there. There are many items, many items following the provisions of Income Tax Act. They are disallowed in nature. So you will add back and automatically your taxable income will increase. So the basic question, whether the tax is calculated on PBT? No, it is calculated on the adjusted PBT. That is PBT as per Companies Act will be adjusted for various items following the provisions of Income Tax Act. Then a taxable income will be calculated and only on that tax will be calculated and arrived out. Thank you so much. We have come to the end of this webinar and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2,000 rupees. But for you, I'm going to give you a special offer. Here we go. Banking Credit Courses Bundle. This includes course number 1, Banking Credit Analysis Process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2. That is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like auto credit facilities, letter of credit and all. So far, I have introduced 7 courses of 1,999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, Collateral Securities, a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over, some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.